Our guest this week is Graham Pingree. Graham is a partner in Cendana Capital, a fund-to-funds firm that invests in small venture funds investing in pre-seed and seed. We talked about why Cendana invests in emerging managers, what they look for in them, how to think about reserves and recycling, and why big venture firms are surprisingly hard to kill. Please enjoy. Graham, thanks for coming on the show.
Pleasure to be here, Jeff. Thanks for having me.
Maybe you can get things rolling by telling listeners about the strategy at Cendana.
Sure. Yeah, Cendana, we are an early stage venture fund to fund. We focus exclusively on small funds that are deploying capital at the very earliest stage. So for us, that means all the checks are going in at pre-seed and seed, and the fund sizes tend to be below 100 million in terms of vehicle size.
Okay. And you worked at a couple of different prestigious shops before joining Cendana, but how did you end up at the firm?
Yeah, I've been on the institutional limited partner side for most of my career. Started with Cambridge Associates in the early 2000s, working with endowments and foundations with large non-marketable portfolios. So did a lot of venture and private equity fund selection, and then joined Horsley Bridge Partners, which is another large fund to fund that's been around a very long time. And spent a few years with them out in the West Coast, as well as a year in London. So had been in and around the venture world for most of my career prior to business school, and then tried my hand at operating at a venture-backed startup for a couple of years, but wanted to move back into the investment role and really to focus on the part of the market that I felt like was the most interesting and offered the highest potential to multiply capital on behalf of LPs. And that meant finding a strategy that focused on early stage small funds. And at the time, I was looking for a job. My partner, Michael, had recently started Cendana. And so I joined him as the first employee at the firm back in 2014. So more than a decade ago. But it was a little bit of a continuation of where my interests had been over the course of my career, but more of a refinement on the part of the market that I felt like was the most exciting.
I agree. And maybe to that point, could you talk about the fund of funds landscape at large today? Like the range of different offerings out there and where the points of differentiation are with fund of funds?
Yeah, there's certainly a number of fund to funds offering available, and I think they do provide LPs with slightly different looks and different types of exposure. Everything from a mixed kind of asset approach with a combination of leveraged buyout, growth equity, and venture capital all under a single umbrella to more targeted exposures, and then even within the venture landscape, there are some of the larger fund of funds that tend to focus on the more established platform firms. I would put Cendana on the opposite end of that spectrum. Most of our commitments are going to relatively emerging fund franchises, and as mentioned, often to quite small vehicles. I mean, we're comfortable committing to funds that are $20, $30 million, whereas many of our peers, that's simply not in scope for them. So I think there are a lot of options available to LPs who are looking for a fund-to-fund solution as a way to get exposure. As I said, even within venture, it feels like there are quite a few flavors today, to say nothing of secondaries and some of the other offerings.
Does it feel like most LPs with fund of funds and venture are looking for beta to the asset class, or are they looking for alpha?
I think that's probably fair. That many LPs are thinking about getting tech or innovation beta, broadly speaking. One of the benefits of a fund to fund offering is you are getting a certain level of diversification, which does mitigate downside, right? You're inherently getting a portfolio of a number of different companies, typically across various regions and sectors. And the benefit of that diversification is the chances of capital loss are relatively lower than a much more concentrated venture portfolio. But as you kind of alluded to, that also caps the upside. And one of the things we really strive to do at Cendana is strike the right balance between an appropriate level of diversification, which we think is going to allow us the best opportunity to capture some of the outliers, with enough concentration that any single investment can still have a real impact on the aggregate performance that we're delivering to our LPs. So for us, it's we don't want to be overly diversified, so that you're watering down the impact that any single deal can have. But you need to have an appropriate basis across a number of different opportunities, and also importantly, a number of different vintage years. And that's another major benefit of fund is, our funds typically contain 6+ vintage years of diversification. So you don't have the kind of acute market exposure that you might find in a single venture capital fund, which can sometimes be deployed in 18 months.
You mentioned pre-seed seed earlier. The definitions around those can get blurry. I've got some pre-seed companies that are more mature than some of the seed ones. So the nomenclature can blur. What does that mean to you and Cendana?
What I would say is, historically, we probably put a little bit more focus on tightly defining the categories than we might today. I think, to your point, there is increasingly a blurring between the two, pre-seed and seed, and I think in our minds the distinction today is probably a little bit less important. Historically, we used to think of pre-seed as truly pre-product investing, often ideation stage, and usually that correlated to investment round sizes of a few $100,000 up to $1 million or maybe $2 million. And seed today, those rounds tend to be into more mature companies. There is early revenue. There are some actual financial metrics to evaluate, and the seed round is used to catalyze kind of finding proper product market fit. And then Series A today is often pouring gasoline on the fire and trying to scale that up. But I think, to your point, we see pre-seeds getting done in highly pedigreed teams that have maybe a rough idea for what they want to build. But certainly, if it's in the sphere of AI, like those deals can get done at very high valuations for what we would have historically considered pre-seed.
Where do you feel like, in acknowledging the boring of pre-seed and seed today, but if you kind of use extreme tentpoles of where true pre-seed might be, as it may have been thought of previously, and then more mature seed as it is today, where do you feel like the bigger opportunity is right now for deploying for managers?
I think, for our strategy, right, we I think have biased earlier and into smaller funds. So we have done more strategies that tend towards pre-seed. And I think part of that is a reaction to the competitive dynamics of the seed market, right? If you go back to when my partner Michael founded Cendana, there were 20, 30 institutional seed funds. And even probably 5-7 years ago, the market was nowhere near as crowded as it is today, where you have thousands of dedicated seed strategies in the US alone, to say nothing of all the bigger platforms that are now coming back to seed and increasingly chasing some of these opportunities. So I think unquestionably seed is more crowded today than it was a decade ago. And so there are a couple different ways we believe that you can still create some structural tailwinds to the way that you're executing early stage venture. One is you go earlier than those seed rounds. So truly ideation stage. We have some fund managers that identify talented individuals who are at a larger corporate or hyper growth startup, and try and convince them to spin out of the company to start something new. So those deals never even get to market. So hypothetically, it should be both proprietary and you should have more kind of pricing control in those types of pre-seed opportunities. The other thing that we believe in this market is if you maintain discipline around your fund sizing, you necessarily have more optionality. So the bigger your seed fund is in today's market, we believe that means you have to lead your deals much more consistently, if not all of the time. And so the ability to write a smaller collaborative check, maybe alongside one of the big platforms, it just becomes harder for that portfolio math to work. Whereas a fund at 50 million in today's market, we believe they have the flexibility to kind of size up to co-lead a seed or pre-seed, but also take that 5, 7, 8% ownership alongside another bigger fund, and it just gives them more avenues to consider. So we again bias towards smaller funds, probably in a market that's become more crowded.
Cendana has 3 filters, at least focused on the website, that identify great fund managers: portfolio construction, networks and ecosystems, and intangibles. If you had to ride or die with just one of those, which would you pick and why?
Well, that's a good question. Amongst our partnership, I am probably the most kind of like absolutist about portfolio construction and fund sizing. I think if you start with the premise that we can select generally good fund managers, I think even if you pick a great investor, there are some fund models that it's really difficult to make them work. So I think getting that model right allows you to achieve excellent investment performance. I think you can still be a great investor or deliver great performance, I should say, if you don't have anything remarkable in terms of intangibles or differentiation. And I think there are probably some seed funds that can succeed even if they don't have the right network or aren't operating in the right ecosystem. If they have picked great companies, maybe those companies find their way to the right downstream funders as they're ready to raise A's and B's. So I think it's a handicap to not have a differentiated strategy or be operating in the right network or ecosystem. But I think if you're building your portfolio model incorrectly, that's probably, in my mind, the hardest thing to overcome.
And when you're talking to emerging managers, is that one of the biggest challenges you run into as far as sophistication around portfolio construction?
I think in some cases, yes. That said, there's so much more written about fund management today. So I think that fund managers often come to us with actually some level of sophistication about how they want to build a portfolio. There are often nuances that they haven't spent as much time thinking about, that the exact ratio of the fund that's allocated for reserves and how they intend to use those reserves, how they intend to recycle capital to get closer to fully invested on the commitment amount, and try and kind of mitigate that fee drag. But for the most part, I feel like in this market, most of the funds that pitch us have some idea of how they want to execute a portfolio strategy. I personally think what's more of a challenge for us is determining whether we believe that this particular fund manager can execute on the strategy that they've laid out. And I think where the rubber meets the road for us is most often when someone is transitioning from perhaps an angel track record where they've written small checks into a number of deals, and they're trying to institutionalize and professionalize into more of a fund manager. So they're raising more capital. And the question that we need to determine is, do we believe that they can access the same caliber of investments with maybe a 500K check that they were able to in their angel track record with 25K or 50K. And transparently, that's one of the bigger challenges in our job. Do we believe that people can cross that chasm and maintain the same quality of deal flow in a way that often now they're competing with people that they used to collaborate with, and people used to send them deals because as an angel, 50K on a cap table, maybe the value they provide is way above that, but at 500K, that calculus might look different. And I think figuring out when we can have conviction that people can make that transition is one of the challenges of our job. And honestly, we do a lot of reference calling to help us try and determine that. So we will talk to a lot of the entrepreneurs in that angel track record about the way they've engaged with this investor, and if they had an institutional fund, would they be willing to carve out more allocation for him or her? And then often much more pointed questions about, okay, you took 50K from this individual out of your $1.5 million seed round. If they want to do 500K, I'm looking at the cap table on Crunchbase, like who isn't gonna make it onto the cap table, right? Like
Who's getting voted off?
Yeah, it's a zero sum game. Like something's got to give here in terms of allocation, unless you as a founder are going to take more dilution. And so we get to ask some of those compare and contrast questions, which really inform our thinking around can they make that jump.
I know you've got an ownership bias, and which I understand and agree with, but do you ever see situations where someone's superpower is around their network and writing collaborative checks? And if they're going from a $5 million fund to a $20 million fund, if you can stomach, well, ownership levels are going down, but we'd actually like to see check sizes stay consistent so that they can continue executing on what they do really well. Do you ever come across that, or is that just a pass and doesn't fit with the strategy?
I think in our mind, I mean, if we found someone who we think had incredible access and was able to build a portfolio at $5 million fund size with reasonably small checks, and we felt like they were consistently winning, access at whatever it is, 50, 100K, and they wanted to scale up to something bigger, but we didn't feel like the check size would necessarily scale, or if it did scale, it would compromise the quality of the deal flow. What our bias would be is to try and convince them to keep the fund reasonably small. So I think, which transparently is a great challenge in this industry, and we understand why. I think the economic incentive structure of fund investing always convinces people that they can replicate the same success with incrementally more capital. And so what I think one of the challenges that we have is finding the right balance between ambition. I mean, you want to back people that are looking for generational talent and these huge outlier successes, but also some modicum of like both discipline and self-recognition that like maybe the access I'm able to get to as an angel doesn't translate to a bigger fund size, and maybe my superpower is my willingness to collaborate, and the reason that people are sharing these deals with me is because I write a complimentary check, and if I was trying to lead or co-lead, it might not mean the same level of access. So when we find people who I think are committed to like those collaborative strategies and staying small, we do think that can absolutely work. So we don't think about, what I'd say is we don't think about ownership in a vacuum. We think about it relative to fund size. So that's the ratio that's kind of critically important to us.
And can you talk about how you size up reserve strategies with managers?
Yeah. I would say our thinking around reserves, I should say my thinking around reserves has evolved somewhat since I joined Cendana. I mean, if I look back at our early funds, we used to focus mostly on fund managers that were exclusively leading their rounds, and as such, they had to have reasonably chunky kind of reserve strategies in order to continue to support those companies in subsequent rounds, right? If you were the lead investor at the seed, your participation in the A really mattered. There was a real signal there. And similarly, often as seed, the kind of overarching stage has elongated and there are now multiple seed rounds, as a lead investor, you needed to be able to catalyze a subsequent round in many instances. So you needed to be able to start a seed two. So you needed an allocation to be able to do that. I think today, as we have branched into some strategies that are more collaborative, we feel that you can actually throttle down reserve ratios, which should provide a little bit more kind of juice to the overall fund performance, right? If you're a $20 million fund, we think that can be principally first check capital. And so usually that means trying to write slightly incrementally larger checks, or doing a handful more deals out of that portfolio versus reserving 40% of the fund to follow into the A's. I think we have refined our bias around reserves to a viewpoint where today the smaller funds, we just don't think heavy reserve strategies are necessary, and in fact can be detrimental to fund performance.
What's your view on recycling?
Yeah, we are very much in favor of recycling, and having spent time at other institutional limited partner shops, I think that's a pretty consistent viewpoint across the industry. I believe, like, where there's some tension occasionally is some family offices that LP into funds like to get capital back sooner. Our opinion is, if we've underwritten the a particular manager, and we have conviction in their ability to pick great companies, we want to try and reduce that fee drag as much as possible. So we want if possible, every dollar of the capital that we've committed to a fund manager going into companies. Now, what I would say is, like, I think recycling is one of those things that you can talk about in theory, but executing in practice is, we recognize a very different challenge, right? It does require fund managers to have some type of liquidity events during the investment period so they can redeploy some of that liquidity into the portfolio, either doing new deals, although that's less typical, but more commonly into the later rounds of the portfolio that they've already built. I think this has been an interesting learning for me. We haven't done as much on the kind of crypto Web3 decentralized space, but we have a handful of fund managers there, and as I'm sure you're aware, the liquidity profiles can look different with token offerings, and often that can mean these funds have a little bit more flexibility around recycling. So that's been an interesting observation for me. It's this new category of fund managers just seem to have the ability to generate a little bit earlier liquidity and modulate how they can recycle that capital to push closer to fully invested.
It's been a pretty brutal time for emerging managers to raise. If 2021 was like a golden age for emerging managers, 2024 would be something like an ice age. 25% fewer firms in America deployed last year into U.S. venture than 2021. How does that, or does it, affect how you approach going about finding managers and supporting them?
Yeah, I mean, I think hypothetically it should mean there's less noise in terms of the market that kind of we're identifying and trying to select from. If there are fewer emerging managers, our selection process maybe isn't as complicated as it was in 21, where, as you said, it felt like there were 5 new funds raised a day in our part of the market. I think what I would say, the kind of like human side of this business, is one of the things I like to tell the funds that we back is, maybe in contrast to the more permanent pools of capital like endowments and foundations, one thing you should get from a fund to fund when you're pitching them is some level of empathy, because we have to go raise capital ourselves. So we understand what it's like to be out there trying to pitch LPs and get them to believe in your story. And I think from that, the kind of like more human part of it, we recognize how challenging it is in the market today. And really, one of the things that we try and bring to bear as like a very tangible value add when it comes to the funds that we back at Cendana is help on the fundraising side. We think that, at a very basic level, our participation is some kind of market signal around the credibility of an often emerging manager, which should help attract other LP capital. But I would say even more directly, we make a lot of introductions on behalf of the GPs that we back to other LPs in our network to try and help them really craft the right LP base for the funds that they are raising. So that's part of our role that we take really seriously, and we when we've decided to commit to a partnership, we try and work really hard to make their fundraising process as seamless as possible. But to your point, there's no question it's an incredibly challenging market for new funds, and I think it's going to take longer for people to hit their targets. I think in many instances they won't be able to, and they'll have to try and execute the strategy with less capital than kind of what they deemed as ideal. But yeah, that's absolutely where we are today from a kind of LP macro perspective.
Q4 had more money go into startups globally than at any point since mid 2022, which feels like things starting to thaw, at least from the perspective of managers. When you talk to other LPs, where are LPs on the cycle of getting over the hangover of the past few years?
In a much better place than they were 18 months ago. So I think that's the bright side. I think our peers on the LP side are open to having conversations with new fund managers, whereas truly a couple of years ago they didn't even want to bother because they knew there was almost no chance of getting anything over the line. So I think allocators have some capacity to add new relationships over the next 4 to 6 quarters. So they're engaging in some of these conversations, but it's nothing like the open floodgates of 21, where it felt like everyone was looking to build more venture exposure and adding new names to their roster. It feels to us like a little bit of a return to normalcy. A rationalization where we're seeing promising emerging fund managers able to raise capital and get things off the ground. But there will be plenty of people who go out and try and raise and aren't able to, certainly.
I've heard you mention in different conversations you've done in the past talking about, and you spoke a little bit here on the gap between markets where you can have a lot of early stage investment but less follow on in that market. When you're talking to managers about scaling, is there ever interest for founders in markets where there's underserved later stage capital or growth stage, with them bleeding into that as part of the strategy, or is that just too far afield from wanting to keep it small and tight?
Yeah, I suspect those opportunities exist. It's just far enough outside the purview of Cendana's focus on small and early. I think unquestionably there are opportunities to focus more later stage capital on underserved or um, underfished ponds. Although one observation I would make is that in our mind, the fluidity of capital at Series A and B has changed dramatically over the last decade. And part of the reason that we used to bias towards seed strategies that were effectively co-located with the downstream investors. So seed funds that were in Bay Area, New York, because that's where the bulk of the life cycle capital resided. I think today the willingness of the big platform funds in the Bay Area, New York, to go further afield to find great opportunities. It feels different than 10 years ago, and certainly before that. And part of that is probably because you can have first introductory calls via Zoom versus getting on a plane to meet someone. But so in our mind, the like connectivity to the downstream capital centers is still crucially important. But the challenge, if you're a great company building in Detroit or Atlanta or Austin, I think the ability to attract that downstream capital, it's higher today than it used to be. There's less friction, I believe.
What's a conventional view in venture that you think is BS?
I don't know if this is a conventional view, but it's something we debate amongst our partnership a lot. I think given the chill in the market and that statistic you mentioned about 25% fewer venture funds backing companies, I think there is a prevailing thought amongst LPs that there will be this kind of washout amongst the venture ecosystem, that funds aren't going to be able to raise successor vehicles, and some of the brands that have been around for a long time will kind of cease to exist. I joke about this with my partners. I've been doing this for 20 plus years. I think about when I started my career in the early 2000s. There were venture brands that I thought there was no chance that they would exist in 5 or 10 years that are still around. So I think for the bigger established funds, it's just really hard to kill a venture fund, even if maybe the performance warrants it. I think for the smaller,
Why is that?
well, I think they have sticky LP bases that have often been with them for a long time. I think there is a perception of kind of brand value and stability amongst some of the bigger allocators. So they'd rather allocate to an established brand that is maybe well known versus something more emerging. It's just perceived as riskier. And some of it's the reality of like these big allocators have to write sizable checks. So if you're, if you have to write 20 to $50 million into a fund, obviously playing in the part of the market that Cendana focuses on is unrealistic. So now what I should say is I do believe there will be smaller funds that are less established that don't have institutional LP bases that will have a lot more trouble raising second or third time funds. And I think some of those funds will cease to exist, but I think the bigger platforms are pretty sticky, and I don't see many of them going away over the next decade.
I'm guessing that you get pitches practically drop from helicopters. That's Cendana from emerging managers. So there's no shortage of deal flow for emerging managers. But what is your preferred way if an emerging manager wants to connect with you? What's your dream way it happens?
I'm happy to try and answer cold outreach. we really try and meet with everyone who is raising a fund that fits our strategy, because we are relatively specialized, compared to many of our peers out there. We only focus on small, emerging, early stage funds. So we feel like we need to canvas that whole market. So if people reach out to me blind, I do my best to get back to them, and we try and take a meeting. I do think connectivity from our network is helpful. We do a lot of off-list referencing. And so to the extent that one of our GPs introduces a new fund, especially if they say something like, look, I really respect this person, but I also, have to truly compete with them. And, I think if I'm going head to head with them to win allocation with a great founder, it is it's a good fight. That's a very strong endorsement. So I think, I am open to cold outreach if you don't have connectivity to us. If an intro comes via our network, I think that's great as well.
Great. Well, Graham, this is really fun. It's a really interesting conversation. Thanks for coming on.
Absolutely. Pleasure's all mine. Thank you so much.
Hi, Joe again. Thanks for watching the show. If you'd like more of this in the future, subscribe to our channel. If you'd like to learn more about Seaplane Ventures, just check out seaplaneventures.com. Cheers.